One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights, the show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. My name is Alex Mason, and I am your host. Thank you for joining me. We're going through accounting fundamentals right now, and today's question is this. If cash is not recorded as revenue, what happens to it? If cash is not recorded as revenue, what happens to it? Now, we know that generally, if we were using a cash-based accounting method, all the way back in episode 8, we talked about this, it would show up as revenue, right? If you're a business, you get paid some cash for some sort of product or service that you offer, then that's revenue. Boom, you record that on your income statement at the very top. That's called the top line, and that's it. But that's not always the case. What is going on? I mean, even in accrual accounting, you could record cash as revenue too, right? Because you get paid for something and it gets recorded as revenue because you sold something, and that's it. So really, what is a situation where you don't record it as revenue? Well, this is what is called deferred revenue. In the case of cash being collected but not recorded as revenue, it's called deferred revenue. And that is, it's the revenue that the company is going to recognize at a later date when the goods or services are rendered to the customer. So, regardless of whether you're using cash-based accounting methods or accrual accounting methods, in many cases, when the company sells goods or services, if the goods or services are exchanged at that moment when the cash is received, then boom, you record it as revenue. And even if you exchange it a little bit later, maybe there's some accounts receivable in there that you're waiting on some money, well, boom, you record that as revenue once the goods are exchanged. However, this deferred revenue concept comes into play when the goods or services are being rendered at a later date. So let's say that a customer pays you up front, if you're the business, pays you up front, says, hey, you're selling something, I want it, I'll pay for it right now, you can give it to me later. Okay, well, you got the cash as the business, but you can't quite record that as revenue yet because you didn't give them what they paid for yet. Now, another important point about deferred revenue is that deferred revenue is accounted for in the financial statements on the balance sheet, and it's actually counted as a liability. Now, over time, once the goods or services are rendered to the customer, deferred revenue gets turned into revenue on the income statement. So over time, you could imagine this deferred revenue amount going down, and at the same amount that it's going down, the revenue line on the income statement is going up because the company is now recognizing the revenue as goods or services are performed. Now think about something like a subscription business. Maybe I'll just make something up like a massage membership. Maybe you want to pay for an entire year up front. So you give the massage company all the money, and then every month you go in for your monthly massage. Maybe you get like a monthly credit or something like that. And so as you use that monthly credit, the massage company is going to recognize 1/12 of the revenue based on the cash that you gave them because they actually performed the service of giving you a nice massage and helping you feel all nice and relaxed. So that's an example of where you might see this looking into the financial statements. One quick note here that I want to make about something I just mentioned a minute ago, which is that deferred revenue is listed as a liability on the balance sheet. Liability. Well, why is it listed as a liability? Remember, liabilities are things that the company owes, and assets are things that the company owns. So, if we're listing it as a liability, that means that this deferred revenue, it's an obligation that the company has. And it kind of makes sense, right? Because the company has received the cash, but this cash isn't really being reflected on the income statement yet. And let's remember what the income statement does. The purpose of the income statement is to show profit and loss. So if we got the cash, but we can't yet show profit or loss related to that cash, then we're obligated to show that later at some point. That's how I think about it. So that's why deferred revenue is listed as a liability on the balance sheet in my view. So that's the concept of deferred revenue. And that is what happens to cash if it's not recorded as revenue. It goes to the liability section of the balance sheet and is recorded as deferred revenue. Okay, that's what I got for you today. This is Alex Mason with Investment Banking Insights. And I am just so grateful that you're here. Thank you for listening to the show. If you're getting value out of this, please rate, review, and share this podcast with anyone you think would find it to be useful. And I'll see you on the next one.